Coming up on this episode.
Don't try to trade like me, try to trade like you should be trading.
Yeah.
I'm a big proponent of that. I don't think there's one strategy for everybody. That's ridiculous because everybody's different. Volatility is part of the game and just stick it out. Well, that's kind of stressful and you can't be Mr. Serenity if you're doing that. As Tharp used to say, you could either trade the markets and because you like the excitement and therefore you will get excitement, or you could trade the markets to try to make money. How about if I offer this? I would be intrigued to learn what you're doing with TradingView and how to do that. And I would be happy to be on the seminar or webinar or whatever. And then I could throw in some suggestions along the way if I spot stuff.
Okay, hello and welcome to Tools of the Trade, the podcast that takes you behind the scenes with industry legends and rising stars in trading and finance. I am your host, Jeff Boccaccio from Rfactory. That's the letter R Factory. And in each episode, we're going to dive into the technical tools from trading platforms to programming languages, market internals, but we're also going to touch on the mental strategies that the pros use to stay at the top of their game. So get ready to discover tools that can elevate your own trading performance and raise your trading up to the next level. Now, Episode 1. This is the first episode, yay, but it's also a little bit different already because, how can it be different already? We're going to jump straight in with a round 2 conversation with the legendary market wizard Tom Basso, of course, aka Mr. Serenity. Now, how can we have a round 2 conversation when this is episode 1? Well, it's because I recently had a fireside chat with Tom that I did on behalf of the Society of Technical Analysts, the STA, which we're going to call that the round 1 conversation. And just to keep everybody on their toes and make it that little bit extra confusing, we are looking to release that as in episode 2. So keep an eye out for that. But there was so much goodness in this episode that we wanted to get it out ASAP. So stay tuned for a whole bunch of goodness there. We are going to go deep into trading strategies today, and we even design a mean reversion system on the fly. So stick around for that. But also, we cover a whole bunch of practical aspects of running a portfolio of strategies designed to complement each other and also to complement your lifestyle. Finally, we've got a one-day intro to system development workshop coming up. It's in November. It's going to be on Saturday the 16th. And we're going to be coding some of Tom's indicators and systems as part of that workshop. And turns out Tom himself got interested and he's going to come along if he can make it and perhaps even chip in with some ideas on the day. So check out rfactory.io for details of that. And if you can't make it, that's okay. Or if the date's passed already by the time you're listening to this, there should be a recorded version available. So check the website there. So without further ado, let's get on with the show. Enjoy. Good morning, everybody, or good afternoon, or good evening. Thank you for joining us. Welcome to the inaugural episode of what we're, at least internally, calling the Tools of the Trader podcast, hosted by myself, Jeff Boccaccio. And if it's okay with Tom, let me tell you just a tiny bit about me before we sort of get into it. I am first and foremost a trader, so I'm a trader myself, but I'm also a co-founder of Rfactory. It's a company that I have with my partner Subtle, where we are all about elevating trader performance, right? We're all about just trying to make traders that little bit better in whatever way that we can. And we tend to do that in 2 different ways. It's both technical tools and education, which is kind of my focus. And then there's also a lot of work that we do with trader mindset, which is it's sort of a unique approach where we're trying to ensure deep alignment with a trader's subconscious drivers all the way like through to the actual execution. So it's like subconscious, making sure all that works through to execution. And that is Sonal's specialty. All of that's really kind of for another day. I just wanted you guys to understand who I am and who we are. People have been kind of twisting my arm for a while to do some sort of podcast. So I'm really excited to be actually doing it and kicking it off. And Tom has been such a good sport with the whole thing. And then we decided, well, let's do it with a live audience because, what could go wrong with that, right? Why make it easy? But it is easy. It is easy, actually, because I know that it's just going to be a conversation with Tom, which I'm super excited about. So a little bit of backstory. I'm also a director and board member of the STA, that's the Society of Technical Analysts, and I run the events program there. And so it's a little bit of a cheat. I got to talk to Tom about 6 weeks or so ago at the beginning of September, where we had a really good round one fireside chat. Where we had a hard cutoff, and we could have just kept going for hours. So maybe
We
it was
could
good.
have we could have gone for 4 hours, I swear.
Maybe it was good that we had a hard cutoff that day, you know?
Yeah.
Um, so anyway, let me get straight into it. Tonight are of course joined by the market wizard, Mr. Serenity, Tom Basso. And so I know he doesn't really need much of an introduction. And for maybe a deeper introduction, I've referred to the previous chat, the round one, but just a couple highlights. 50 years of trading. He was CEO of Trendstat Capital Management for 20 years, where they were managing, I think, up to around 600 million at peak, using similar techniques to what he's doing today. There's always evolution in this game. I'm sure Tom would agree. But you
Mhm.
know, it seems to me, by talking to guys who have been in the game for a while, that the things that work tend to continue to work. And then, of course, there are some strange sort of market anomaly things that you can sort of um, you can make use of at certain times, but the longer term trends and that sort of thing tend to persist. Tom's authored numerous books. A couple ones to point out are The All-Weather Trader, that's his most recent one. Also has one on position sizing. Um, and his website, enjoytheride.world, where he shares lots of his experience, basically. And from what I understand, that was a way of getting all of the information and questions that people were throwing at you into one spot so that you could answer them and have a lot of information in one space. So there's a lot of really interesting information there. So I would encourage everybody to go and check that out. So Tom, welcome to the podcast, and thank you for talking to us again.
Good to be here, Jeff.
Now I can see that we were chatting just a little bit before we kick things off. Tom's in a different spot from the last time when I spoke to him. So Scottsdale today, yes?
Yeah, actually, the hard cutoff, if you remember, was I had to get on the road to get back down here to
That's right.
Scottsdale, Arizona, in the Valley of the Sun, as they call it, from my mountain home. We made the transition the same day that you and I were talking, and I had to get down here for a hard appointment down in Scottsdale. So I was like, the car was packed, and I was looking at the watch and then trying to, get done with the interview and get in I had about an hour and 40-minute trip down here. And we made it with about 20 minutes to spare, so no
Right.
problems. But yeah, there was that hard cutoff we had last time. I have no such cutoff. We run the risk today of going forever, and we'll
Okay,
run out of Zoom capacity or something.
that's okay with me. I'm sure we can adapt. Yeah. And so I'm also pleased because I was a little bit worried that day. We did run over just a tad, and I was thinking, oh, but if we make him late, he's not going to be happy with me. But anyway,
No, I was good. Everything was great.
excellent. Um, I thought maybe if it's okay with you, we'll try a couple things out today. We covered a whole bunch of stuff in round one, and I'll leave people to go and check that one out for themselves. Um, Today, I thought we could kind of jump into a few things that we maybe didn't get to last time, and maybe some practical sort of just example workshopy type things too, like running through a system idea. But before we jump into that, just a few questions and maybe just to familiarize the audience a little bit with some of the things that you do. Um, you talk a lot in the All-Weather Trader about a portfolio of systems. And so you've got I think last time we spoke it was seven different systems that you run. Now I also know that within those seven systems there's actually quite a lot going on in each one. So those seven systems have
Well,
many different markets. So there's target selection and filtering and ranking and all of that kind of goes on inside of those two.
mhm.
Could you just describe just briefly for us what the sort of seven is that you're running currently?
Yeah, what I'm trying to do, in essence, if I tried to globally describe it, is I'm trying to diversify myself as much as possible. So where most traders will come up with, okay, I look at the chart, I look at the daily chart, or I look at the 5-minute chart, or I look at the 60-minute chart, whatever they happen to do. And it's all good, whatever you want to do. What you'd end up with is a focus sort of in one time period with particular set of indicators, with a particular set of instruments that you're likely to trade, because the human mind just can only take so much. I mean, can you watch 50 things with 4 different time periods with 5 different indicators? That would be overwhelming. You just couldn't, you'd spend all day just flipping through, and after a while, your mind gets numb. Well, because of my engineering background and my leaning towards automation of things, at least part of what I do can be automated. And the creation of strategies is where I use my creative juices and try to come up with new and different ways to attack the problem. And the reason for 7 right now is that let's start with the very oldest one, is a very long term. I use an indicator that I created back at Trendstat days. I call point and figure bar. It's not important. It's kind of like point and figure charting if you get the point and figure book, but do it with bar charts. That's all it is. It's nothing magical.
Is the
It's
is the
just
R in PFR? I mean, PFR sounds to me like point figure. Does the R mean bar or does it mean?
point
Yeah,
and
okay.
figure bar. So I'm
Yeah,
using
gotcha.
point and figure concepts on bar charts. That's all it is.
Gotcha. Yeah.
And, you know, for me to explain it would be the first hour of this interview, and I'd have to
Okay.
share the screen, and I'd have to dig out my whiteboard, and
No
half the
worries.
people that are listening to this would never understand it anyway. You got to realize I've been doing it 45 years. It's about as easy as breathing to me, but
But I
it's not
guess if
something that you'd see on your local broker or trading platform because they wouldn't have it.
if
Um,
if I were to guess, though, it sounds to me like it's a breakout type
yeah,
strategy where you get a breakout and now you're running with the trend. So a breakout trend following strategy.
the closest thing to it would probably be a Danshan, and
Yeah.
probably something around, I don't know, 15 to 21 days. Danshan would get you in the ballpark of what I'm
Okay.
doing there. It wouldn't be exact, but it would be a simulation sort of for the most part. There'd be a lot of similar signals, so no big deal, nothing magical. But it's something that's different, and I've been doing it. But the point is, it's more long term.
Yeah.
So then I sit there and okay, I'm trading 35 markets long term, ranging from equities to debt to precious metals to non-precious metals to energy to currencies, all sorts of softs. So I've got a lot of different markets, and I've got the long-term trends nailed. And this is a long or short, always type of strategy. So if
Right.
you think back at that math, you say, okay, well, let's see, when the markets in any one market are going sideways, I'm going to struggle with a long-term strategy, because you're either going to be fortunate enough not to do any trades, or you're going to get whipsawed a little bit because you're never going to get a long-term trend that carries very far. The other side of it would be like a cocoa market a couple of years ago, or
Yes.
an orange juice market that takes off, or stocks in the last few years have not been too bad. So you get these long runs, and you nail every one of them with this particular math. So that's the good news. And the bad news is, of course, the risk per contract of everything I'm trading is pretty large. And so the drawdown after you get this long run is, sooner or later, it's going to come back to your stop. And
Yeah.
your stop's struggling to keep up with how fast the market's moving. So you're going to give up some of that nice profit. So you look at that and you say, okay, let's see. The problem with the drawdown starts from the equity high. The day that I hit equity high, the day this particular one market or a cluster of markets really, really gets extended to its last day on the move, and then it starts snapping back towards the stop loss. And then you say, well, what can I do to solve that? Well, and then you say, how about if I created a very short-term strategy? Maybe to describe one of the ones I use is a 3-day Danshan on the same 35 markets. So
Hmm.
let's think through the math there. As soon as like within a 2 or 3 day period of snapping off that peak of this extended move, you're going to have this short-term model going short that move with the same market. So what
Right.
happens net in your portfolio? All of a sudden, one is short, one's long. You've either minimized your exposure or you may have zeroed it out even in some cases.
Yeah.
All right. So now what you've done is minimize the first part of that drawdown that you are going to sustain sooner or later. So mathematically, your return to risk just went up, which is nice because I'm a retired guy. I don't want to go back to work managing other people's money. I'm enjoying retirement for pushing 20 years now. And so that's kind of keeps my drawdowns minimized a little bit right there. And then you come up with position sizing and you start thinking about that. And back in the day when I was a lot younger and more foolish, I would get into a position and then being a good little trend follower, I'd hold on for dear life with that thing. And as it got very exciting and the markets would go up and down a lot, I would
Yes.
end up just holding on for dear life and knowing that sooner or later it's going to stop out and I'm going to make a profit. I just don't know how much yet. And yeah, volatility is part of the game and just stick it out. Well, that's kind of stressful and you can't be Mr. Serenity if you're doing
Right.
that.
There
So
could
I,
be there could be big drawdowns, right, on some of those longer
yeah, well,
term trend following
you can
positions.
you can
So,
have some wild swings each
yeah.
day. You can have draw ups and drawdowns, or a
Right.
draw up I call a surge.
Yeah.
Surges and drawdowns, man, you look at your account and you look at the numbers on the green and on the red, and every other day if you aren't really seasoned and really balanced in your mental processes, you're going to be emotionally thrown all over the place. So I started thinking about that math, and I said, what's happening here when I analyze it is that if I've got, say, 25 things in a portfolio or 35 things, and I've got an orange juice or a coffee or the bond market's going nuts or the stock market's going nuts or gold's making new highs or cryptos are going crazy. There's lots of examples of markets that have gone nuts in the last few years. And when that happens, if you look at a really good day or a really bad day and you analyze down to the market, you realize that the one or two or a cluster of markets is really most of your return for the day, and all the rest of the stuff is just nothing. It's a
Yeah. No
lot of
doubt.
work for nothing. And when you start realizing that, you start realizing, well, the drawdown's going to start when these cluster or maybe one market hits its extreme and starts snapping back. So one one thing you can do is to look at your portfolio and say, all right, I had a portfolio when I started this. I had 35 things. They were all fairly sized properly. Everything was cool. Now things have changed. Everybody in the world knows that orange juice is going up or whatever market you want to talk about. And because it's going up so fast, most technical indicators, even if they're volatility adjusted, just it's really hard to keep up with sometimes a market that's really, really surging fast. So your risk per contract or risk per position, risk per share, if you're trading stocks, same thing. NVIDIA, same thing right there. The stop is moving up, but it's not moving up as fast as the position is.
Right.
So your risk is getting bigger and bigger and bigger. And I'm starting to think, if I look at my total portfolio risk, the risk of this one position is excessively large versus everything else. So why not size that position so that it remains a balanced portfolio? So
Right.
what I do, a lot of times on initial positions, I'll size my positions at about 0.5% risk to equity. So I'll take my daily equity, make believe I've liquidated the whole portfolio. The portfolio is worth X, and I calculate my risk on a position, and I put the risk over top of X, and I figure out the percentage. And if it gets over, I started with a half of 1% on the initial position, I'll give it some room to make money. But if it starts getting more than 1% of my portfolio, I just peel off enough position to bring me back into balance. And what that does is makes the whole portfolio kind of balanced relatively. No one position is trying to dominate. I'm still making a ton of money on whatever this superstar is, but I'm not allowing it to become a portfolio of one thing or a cluster of things and then a whole bunch of other stuff that doesn't make any difference. I want everything to kind of be balanced. I want a portfolio to act like a portfolio. In the position sizing, which I wrote up in with the math in my position sizing book, covers how to do that really easily with math you learned in junior high school. And add, subtract, multiply, divide percentages. If you can handle that, you can handle the math.
Yeah.
And you can do it in a spreadsheet. You can program it real easily in whatever language is your preference. And it automatically spits out the alarms and the ability for you to kind of maintain that. So the combination of having a long strategy and a very short-term strategy combined together with position sizing, all of a sudden we've made a big, huge couple steps towards minimizing the early part of that drawdown because our position size at the top is smaller than it was when we started. And we've also got this short-term strategy that's sort of coming in and almost hedging the long-term strategy. So then continuing on down the 7 strategies you asked me about.
Could I before you
Yeah,
jump
go
in,
ahead.
can I just ask a couple clarifying questions there? Just
Sure.
some of the
Yeah.
specifics. So if I'm hearing you right, the that 0.5% risk that you use for the initial position is essentially based on open equity across the board because you're assuming that you've liquidated everything at that point.
Correct.
Sometimes there's a choice. Some people will say, I'm only going to base it off of closed equity because
Yep.
maybe I've got these big open positions. But I think it's hard to do that with long-term trend following because you're in these positions for so long. You really kind of want to allow them to, they should count in my view as well. So I agree. I like that approach.
Well, you can do core equity, you can do realized, well, core and realized is the same, or you can do all sorts of little tiny variations, but you're all going to get in the same ballpark and it's not
Yeah.
worth the trouble. I can look on the screen and see what my net
Right.
liquidation value is. It's a number right there. It's
Right. Half a
really easy to
percent.
pick that up. And in the US, at the end of the year, the IRS, the Internal Revenue Service, make believe liquidates all your future portfolios, and marks them to market for tax
Right.
purposes. So if they're going to do it, why don't I do it? It's
Right.
not a big deal. Easy to do, so that's why I do it. I've tried other forms of equity, and they're going to give you similar results. It's sometimes not worth the trouble to go
Right.
through and do
Keep
that.
it
So,
keep it simple, right? I
right.
mean, I don't want to pull us off track, but your mind brings me to, sitting in Cary at Van Tharp, going through position sizing models, playing the marble game and, trying to beat everybody to the best equity at the end. And the
Yeah.
guys that get themselves in trouble most of the time, they'll just start making errors because they've come up with some really complicated position sizing model that's using markets money plus core equity and it becomes too complicated and it goes too quickly and then they kind of fall apart. And the guys that keep it super simple tend to be the ones that, you know, do the best and often, win that round of the game, right? Unless somebody
Right.
gets lucky, right?
Simple things in trading tend to be a little more robust and certainly a lot easier to execute.
Yes, yeah, totally agree. Okay, so the 1% max rule is,
Hmm.
if I understand it correctly, just to make sure that I'm tracking it,
Hmm.
is that you don't want any single position to be more than 1% of risk from wherever it is, say on the close of the day to wherever its stop is judged by the system currently is. So it might
Correct.
start at 0.5% risk, and then it could grow up to say 1%. It could go to 2%. It probably doesn't get quite that far before you start peeling size off of it to just kind of get it back underneath that 1% threshold of risk. Is that right?
Yeah, at or back to 1. Yeah.
Yeah.
Or
Okay.
below. Yeah. So, it might be 1.2 and I'll peel it back to 1.
Yeah.
Or maybe it peels back. I peel off one contract and it jumps back down to 0.9 or whatever it is. I get it at or below 1 all the
Right.
time, every
Okay.
day, end of the day. And so I allow it to grow. and then I hammer it back if I have to. So it's part of the portfolio. I don't want one position. I don't want a stock portfolio of 10 items, and one of them is NVIDIA. And NVIDIA is literally, 50% of my risk in the portfolio. That doesn't make any
Right.
sense to me. You
Yeah.
really have no portfolio anymore. You have a NVIDIA position and nine other things that don't matter.
Right. And in that case, you probably have NVIDIA plus, NQ or ES in some form, which is a big chunk of NVIDIA right in there anyway, right? If you
Well,
start
then
looking
you're going
at
to
it,
have a really wild ride.
right, with XLK, or you throw in some other ETFs that are going to be bundling it. And yeah, it got to me earlier this year when I started tracking just how much sort of overall exposure different systems had that were all finding the mover and finding the thing that was trending. And it was always NVIDIA and tech and that sort of thing. And I started feeling a little bit
Mm,
more exposed here than I sort of like the idea of if there was something like NVIDIA
yeah.
earnings weren't so good, right? Something like that. And then all of a sudden it comes off 10%, then that's going to put a fairly big dent in your portfolio. So,
Yeah, those magnificent seven that you keep hearing about on the morning business news, uh, there's a whole lot of people in those things, and
yeah.
sooner or later in my lifetime, probably, there will be a rush to the exit, and it'll get very interesting.
Yeah, I think so too. Well, yeah, that was the concern. So we took some measures to try to, fill in the potential pothole that could come with those things. Yeah. Okay, so if now the two different systems, right? So we had the PFR, which is the very long-term one, and then
Mhm.
we had the shorter term one, which is on the same 35 markets. I'm gonna guess those 35 markers are futures.
Yeah, I get my equity exposure in the US. When you're a trader, if you want to register as a trading company, you get certain tax breaks and you can write off expenses and you got to meet all sorts of rules and the IRS will probably visit you and audit you. I haven't chosen to do that. I probably could look at that down the road if I really felt, the need to do it. There's just a lot of extra accounting and stuff. I try to keep my life as simple as possible. But in the case of wash sales, if you buy and sell for a loss inside of 45 days, which is a trader, especially if you have some short-term stuff, you're going to end up with a little of those showing up here and there. And the IRS rules don't really lend themselves to trading securities. They lend themselves to more buy and hold or long-term, like 50-day indicators, 100-day indicators where you're in a position 2, 3, 4 years. And I find that when I'm marrying about long-term systems with short-term systems, I end up with some of my positions that are going to be turning over a little bit more, and occasionally would go into the wash sale rule area. Futures have no such rule in the
Right.
U.S. It's called I think it's a 1256 mark-to-market contract is the technical term, and what they do is at the end of the year they just mark to market all your positions and you have immediately realized gain or loss, whatever it
Right.
is, and then you get 60% of that at long-term capital gains rate and 40% on short-term. And that's a period. That's no wash sale, no nothing. So now I can trade without restriction. And if I need equity exposure, rather than going out and buying NVIDIA and buying IBM and Microsoft and all these different individual stocks, I just can go and buy the IFA index for Europe or the Nikkei in Japan or the Standard
Right.
Poor's 500 futures contract or the the NASDAQ, the NQs. So I trade about six different stock indexes around the world, indices around the world, futures contracts, and I can trade them long or short. So I get my exposure to equities, but I don't have any of the tax problems. And it's just as it simplifies my life, basically.
Yeah.
So I'm getting more and more. I'm down to one position. I used to trade 30 different sector ETFs, and I've evolved to only taking the sell transactions, and I'm down to one out of 30 left now. And that's a utility ETF, surprisingly, and a
Okay.
high dividend. And Yeah, I'm getting into way over a year holding that position, but it still hasn't hit the stop loss point. So I'm just going to let it run until it finally kicks it out, and then I'll have no equity direct exposure. I'll do all my equity exposure more capital efficient wise through futures, and
Okay.
it seems to work for me.
And those, I've looked at some of those markets before. There's not a huge amount of movement or liquidity for a short-term day trader type person, but for a longer term hold, um, it probably works totally fine, right? I mean, so are your
Well, for like, what do you mean by not a liquidity? I mean,
uh,
ES futures contract is massively traded.
I'm not thinking ES. I'm thinking some of like the sector futures and some of the
Ah,
more like you're not talking about those. You're just going to do it
no,
with
I'm
retail.
actually just going
Gotcha.
straight into the big indexes. I haven't even looked at the sector futures at this point yet.
Yeah.
That would
Okay.
be an evolution, and I would probably create something a little bit longer term there, more like what I'd used to do in the sector ETF timing, get more out into the 21-day to 50-day area and just try to hold various sectors that were strong and do it for a long period. And that way, liquidity isn't that big of a deal.
Okay, I understand. Yes, you're not doing down to that granularity, but you're using the larger futures contracts, which are, yeah, super liquid, probably some of the most liquid.
And I do have some long-term strategies there, and I've enjoyed obviously the vastly upward market that we've had in the
Yeah,
long-term side. And then every time it tries to take a dump like it did a few days ago, I end up all of a sudden net short because some of my short-term signals kick in. And then I look a couple days later and I'm getting whipsawed to the upside because now we're back on the
right.
bull market again. And that's trading. It's okay. I'm going to have whipsaws along the way, but the short-term one kicks in and out both directions, and the long-term one, just the steady eddy, continues
Yeah,
to hold on. Sooner or later, when those long-term ones kick over to the downside and line up with the short-term ones to the downside, then everybody better, put plywood over the windows. And,
right.
uh,
Right.
then things could get really ugly quickly. Um,
Yeah,
and I warned traders about that. There's been a lot of traders that have made a lot of money, I would say, since COVID, particularly in the United States, where, we all got those stimulus checks and then people threw them in the market
yeah,
and caught a bull market move at the end of after the COVID crash was over. It was a nice bull market. And with a few little down moves that are not super bears, they've been able to survive and prosper. And some of them are, have quit their jobs and now trade full time and all that. But they're not familiar with what happens in a really, really tough bear market where you might go 2, 3 years down 50, 60% on the indexes. And
yeah,
I don't think people are prepared for the mental anguish and the boredom of waiting for their next long trade that never seems to come. And they're living off their portfolio now, and they can't seem to make any money because the market's going down, and they're all, long focused all the time, and they don't really have enough money to just collect interest and live off of that. There's going to be some interesting stories out there that when that happens, and it'll happen sooner or later. I've done this 50 years. I've seen a lot of bear markets.
been through, not your first rodeo. Seen a few
No,
cycles.
so I've got strategies. If this thing goes down 50% over a couple of years, I got strategies to try to make money during that. And if it goes sideways, I've got strategies to try to do okay there. And if it continues on up, I'll enjoy the ride that way. I don't really care.
Right. In the example that we're kind of using here, and actually what you just talked about with your equities that were so if I'm understanding you right, you're holding probably in the long-term system still equities for probably quite some time. And then in the short-term systems, as we get these minor corrections, the short-term systems might trigger into short mode, and
Yep,
then they might get stopped out or trigger back into a long mode. So now you've almost got like a boosted long because you've got the long term is long and the short term is also now in the long. Um,
correct.
and when you're designing those two systems, the do you check? or do you want them to be both positive expectancy in their own rights without being, grouped together as, say, like part of a little mini portfolio?
That is a super good question. One of the things that I would encourage people to think long and hard about is, are you trying for the maximum amount of return per year, or are you trying to maximize your return to risk? Because what you do to get to those two objectives would be different mathematically, in my opinion, having studied a lot of indicators, a lot of strategies over the years with my computers at Trendstat and now, in retirement. If you're going for flat out biggest return possible, you don't want to limit your position sizing. You want to size it appropriately initially and just let her run and hang on for dear life. You would come out better that way. Your drawdowns are going to be larger.
Yeah.
Your volatility in the portfolio is going to be larger, but your returns over a long period of time, if you can stand it and stomach it, will be higher. So if that's your total objective, go for it. Just realize what you're getting yourself into.
Yeah.
I try to maximize return to risk. So when you think about the math that I just described of the long-term strategy and the short-term strategy married together in the same portfolio, you're going to have some really good surges in your portfolio equity when both systems line up, either to the downside or to the upside. And that's going to happen from time to time. And when it does, and it lasts for even 5, 10 days, you can have some explosive moves in your equity.
Right.
And then there's going to be other periods where the two are going to be offsetting each other, and you look over at your screen and you got 35 markets and 10 of them are at zero position size because they offset each other. And so it's just boring, and the market's trying to go sideways, and you don't know, the market can't make up its mind. Your portfolio is sort of now getting more and more neutral feeling, and that's an appropriate place to be if the market's not going to go anywhere, I think. And then
Yeah.
the other side of it would be, it's a massive reversal, and the short terms kicked in first and stopped your drawdown and bleeding. And then all of a sudden the long term kicks in at the same time late, but
Hmm.
the short term one's already been in on it and enjoying the ride in the other direction. Now the long term one kicks in. Now you're nailing it the other direction. So that is by intention, and the math and the logic and the time periods are all an effort by me to create strategies that I know will be very symbiotic with each other mathematically, so that it's sort of like, if you want to think of it this way, each one is a crutch to the other, or a going against the weakness of the other strategy.
Yes.
The short-term one would get bounce around and all over the place. Now, the long-term one would be steady Eddie and try to do the returns. To answer your question about expectancy, everybody, I think, probably listening to this would know that there's a positive expectancy to long-term trend following. There's lots and lots of studies. You can go to the research page of enjoytheride.world and see some things there. Clearly, you can make a positive return.
Yeah.
Now, if you look at the article that I wrote on timing the S&P or timing the market, I forget, and I updated it in like 2018 or something like that. And it's like 40 years of data or some massive database of history. You'll see that the returns timing are less than the returns buy and hold, because over the last 40 years, the stock market generally has gone up. So again, if you want to do the maximum risk, buy and hold, and you assume the market's always going to go up over the long run, well, then enjoy that ride, but it's going to be a little bit more of a violent ride. And you look at the maximum drawdowns, and indeed, they're much, much greater than if you time the market. And if you look at the return to risk, on the other hand, try to maximize that, then timing the market would be the way to go. So it just depends on what your objective is and how you want to manage that equity curve. And in retirement, I don't want a lot of up and down. So I'm managing the return to risk, and I'm totally happy with that. And I think more traders, if they really got thinking through it all and understood themselves, would probably be more in my camp than the camp of the young traders who are just trying to maximize their returns. Now, on expectancy, I would be totally okay with the long-term strategy being a an expectancy of, we're going to average, I don't know, 10% a year to pick a number. And I'd be okay with the short-term strategy coming in at 4 or 5 if it did a great job of reducing the risk side, because my return to risk gets jacked up so much by minimizing that drawdown. Because
Right.
remember, that's the denominator, return to risk. That's a division.
Yes.
Denominator is fairly significant there. So if you can reduce that denominator, you've just jacked up the total ratio of the two. And I like that. I'll give up, if I had a 20% return one way and it reduced down to 16 or 17 per year, but I cut the drawdown in half, I'm way ahead of the game in my book. To a
Yeah.
lot of people that's saying, hey, you're giving up 4% a year. Why are you doing that? I'm doing it to make my ride smoother, and I like enjoying the ride, as the as the t-shirt or the golf shirt says.
Well, that's it. And like we said, I think before, that's what enables you to be Mr. Serenity, right? It's hard to do that when there's these wild equity swings in your
Yeah,
portfolio. And just like if you can, the more you can smooth that out, the more likely you are to actually stick with it as well. Otherwise, you're more likely to
right.
just bail on the whole idea, which will probably be at the absolute worst time. Um, Been there, done that. So
Hey, if you're not sleeping at night, or you're getting sick over the volatility in your
yeah,
portfolio, or your family or your wife or your spouse is nagging you about, I can't, take the way our portfolio is going up or down or whatever. Or if you're in the management business, you got your clients all over your back, at some point you're human, and it's really hard to be Mr. Serenity with that kind of pressure coming on you.
yeah,
And I get rid of all of it. I have a few exciting days along the way, and I have techniques for that. If I have a real exciting day upward, I try to remember those days that I was in drawdowns. I don't get too excited about the up day. It just
okay,
pays for a future drawdown that might be happening tomorrow. And
right,
likewise, when I'm having a bad day, which isn't as bad as they used to be, but nonetheless, a larger than normal down day, I'm saying, yeah, I remember a month ago I was making new equity highs.
that's
And
interesting.
so you
You're,
kind of bring yourself back to that sort of balance and
yeah,
agnostic. I don't care which way the market goes. I'm prepared no matter what. Let's just execute. And once you get into execution mode and you're not really tying yourself to thinking through predicting and the emotions of being right and the excitement of trading and all those emotional kind of things that happen with a trader, you then can balance yourself out, and that easy to be Mr. Serenity at that point.
yeah. It's interesting because you're essentially describing mean reverting your own trading psychology in a way, right? So if it gets too good, remember the bad, or remember that this can, it won't always be like this. So you kind of getting back to that mean of the average and vice versa, right? So when you're in a
Yeah,
drawdown, it's like, oh, you know what? Okay, this happens, been through this before. We'll come back to the medium and then carry on.
it's
Great.
trading.
Yeah.
Yeah, and I think, I never had a mentor back when I was first starting out. We didn't have the internet. We didn't have electronic trading platforms and smartphones that can transact business thousands of miles away from wherever you're sending the order and have it respond within seconds. That didn't exist back in the days, back in the 70s when I started out a lot of this heavily trading. And, as things have gotten more fast, there's a tendency for the human mind to get entranced with all that excitement, and yeah, and it just tugs you up and down and all over the
Yeah.
place. And the more you can disassociate yourself from that and just step back and just sort of say, what would a super trader do? This is what I did back when I first started. I tried to create this mythical superhero called Super Trader.
Yeah.
And it wasn't me because I was not perfect as a trader. I had a lot of things to learn. But what would Super Trader be doing right now? And
Did he have a cape, Super Trader?
he might have, I don't know. Uh, he but I tell you what, he never smiled. He always was flat.
Okay.
He he always did the right thing. I mean, he
Right.
always executed flawlessly. He never was emotional, never got rattled when the market went against him. He just
Right.
executed his stop loss, took his loss, repositioned whatever he had to do. And when I started trying to model myself after this mythical super trader, I found myself getting closer and closer to, say, Mr. Serenity, if you
Yeah.
want to call it that.
Yeah.
And I think uh, after sort of in the Trendset days when I was managing other people's money, finally getting to the point where I felt like I was there. I was about as good mentally as I was going to get. It was really hard for me to be more aware of what I was doing and more balanced in terms of what my mental states were and all that. And that was probably about the time Jack Schwager interviewed me back in, I don't know, 95 or whenever it was.
Right.
And beyond that, of course, I went into retirement around 2003. So now I'm looking at like 20 years of retirement. And I think because I had mastered the mental side a little bit more, and I had now redesigned and kept redesigning more and more all of what I did trading wise to suit my retirement situation, which is very different from what managing money for other people looks like. The closer I got to matching that up to my own needs, and then having already mastered the mental stuff, and then getting into being able to do interviews like this one, I don't know. I started putting a smile on my face, and it's been there ever since. And I don't feel like I now I can be super trader without having to be this
So
stern look,
stoic.
execution, always perfect.
Right.
Uh, I can relax into the role a lot more.
Yeah.
So it's been fun.
Wow. Okay. I mean, that's great because you've essentially personified the archetype that you want to be and then stepped into it, right? So you basically became that and then decided that actually he ought to have a little fun, that guy. He doesn't have to be such a stickler, so
Well,
stoic.
I'm not trading now. I won't trade. I won't do any updates until, let's see, it's whatever, 8:30 or 8:45 here.
Yeah.
I'll start working on my afternoon process somewhere in the, I don't know, like 5 hours from now or something like that. And
Yeah.
data's got to close down. You got to get the data transmitted. I've got to get that into my platforms that I use for trading. And then I'll start the process and I'll update all my stops and update position sizing and everything will happen. And it'll take me 40, 50 minutes, depending on the day and how the data comes in and all sorts of factors. But that'll be on my calendar this afternoon and I'll do that. But when I get done with that, I may go out and prune some bushes.
Cool. Yeah.
It's, I don't even think twice,
Yeah.
it
I mean,
doesn't.
it sounds great. I mean, because I know that you golf. I know that you do all kinds of other, activities outside of the screens as well. So getting yourself away from the screen, and I'm sure we'll come back to this, but is
Yeah.
one of those ways to become, I don't know, to tap into that creativity that got you to those strategies in the first place. It doesn't always
Mhm.
come when you're sat there staring at charts. It often comes when you're doing something else. And so to enable yourself to be able to go and do something else and then come back and crank the handle for the operational side of what needs to happen.
Exactly.
It just sounds like a great balance.
Right.
Um, I wonder if I could, there's a clarifying question came in as you were just kind of discussing that scenario a second ago, which I wanted to try to address since we have a few people on with us now. And I didn't mention it before, but if you guys do have questions, feel free to throw it in the Q&A box. I think the chat's disabled on this one because it becomes difficult to manage, but the Q&A is not a bad one. And I can help summarize that for you, Tom, I think the question that came in here really was all about like you've got the long-term system and the short-term system. Now, if the long-term system is long the market and the short-term system is short the market, and then the long-term system gets stopped out, it's probably automatically into the short on that long-term system. I know there's a lot of longs and shorts going on here, but essentially both systems are now in short mode, right? Because it's a
Right.
stop and reverse system. Both of the ones that we're discussing here, I think. Is
Both of the ones that I just discussed are,
yeah,
I've got seven, and we didn't get into the other five yet. If you wanted to
gotcha.
do that, I could, but you're just getting more variations on the same theme
Yeah,
where you have different time periods, similar markets, different indicators, perhaps different position sizing algorithms even, but each one dedicated to try to achieve a certain purpose.
gotcha. I did want to ask you about the position sizing aspect of that. If you've got, the long-term system and then the shorter term system, uh, do you have a mechanism for how you size each of those? Like the long,
I actually
you-
intentionally
yeah,
I would intentionally size the shorter term system so that as it went through its initial trade and got to break even on the short term system, I actually peel off half the position, leaving half, and I size them so that at that point I'm dead neutral. So I
uh,
kind of try to size those. See, the risk on a short term system per trade, because it's a short-term indicator, short-term system, is going to be a lot smaller per contract.
right.
So therefore, it can start out at a little bit larger position size than the long-term one.
Yeah.
And then I allow it to just like I take 1 R profit. So I calculate the R on the trade, which is basically mathematically the distance from where I get in to where my stop is. That's 1 R.
Yeah.
Tharp talks about that a lot.
That's
Uh,
why our company is called Rfactory, because I drank the Van Tharp juice way back when, and
there you go.
we think in terms of R. So yeah, I'm familiar.
Exactly. So you know what an R is. Well, when I get to a 1 R profit, if I sell off half the position, I'm now at break even roughly. Yeah, there's commissions, there's bid-ask spreads. Let's ignore that. It's
Yeah.
generally speaking, I'm kind of just locked in a break even sort of. And then I can just let the rest play, do what it wants. If it wants to keep going, great. If it wants to stop me out, I'm a break even trade roughly. If that remaining position is equal to my long-term position then, which many times it is, then they're offsetting each other and I'm at zero.
Okay, I got you. That's a nice place to be actually. So you take a little bit of profit on the shorter term system, and then it's essentially balanced you out. Now that short term system though will also take the long side as well. Is that right?
Mm-hmm.
Yeah. So you're getting that extra boost when things are going up. So do you the 1% of the overall equity rule, does that count on a strategy by strategy basis, or is it a symbol or market by market basis?
Strategy by strategy. So I
Gotcha.
can get it a couple percent all leaning one way
Yeah,
and really rocking and rolling at times. And then for me, at least, for a trader who was totally concentrating on return, they would be even higher. But for me to have big days, I get them all lined up, and yeah, I've got a few percent leaning in one direction on any one market.
gotcha. Gotcha. Cool.
But
Yeah,
I
that
also
makes
have 35 markets and 5 different time periods that I'm looking at, and lots of stuff going on in there.
yeah. Okay, so let me shift gears just a little bit. If we think
All right.
about um it's not that much of a shift. It's really what I'm considering is the way that you net off the positions. So let's say you've got the 7 strategies and then your long-term one, it says, oh, I should be long, whatever it might be, 100 contracts of X.
Yeah.
And then in the shorter term system, it says, oh, you know what? We should be short 50 contracts of X. Do you just, I think you've said this before, inside the computer, as in you do the calculation and say, okay, well, I really want to be long 50 at that point. And do you do that across all of the 7 strategies and then have like
If you're a money manager, it's required
right.
legally. You can't be selling off of one strategy and then buying in another. It's considered to be sort of churning the account. It would be illegal, especially in the case of if you're managing a pension account, which I had a lot of pension clients. So that would be a necessity for the computer. For me, I'm my own client. I'm not going to sue myself. I don't have the government regulators coming in and reviewing my operations or anything anymore. So to me, I just treat them all individually. And if I've got to, sell one over here and I'm buying four over there, I don't net them out. I just
Okay.
put in the two trades and yeah, I pay a few extra pennies of commissions. It's not a big deal.
Okay, I get you. So to me, so it sounds like then practically from an execution point of view, you actually run each strategy on its own dedicated account, or like it sounds like you're using IB, so like a sub account.
I actually run each one and I label all those trades. So I would trade PF bar, would be labeled as PF bar within the nomenclature. I think it's called the order reference or something.
Right.
And then on a short-term futures trade 3-day, I might put ST futures 3D would be the label. And that would be all
I
of
see.
those trades would be labeled that. And
Okay.
if I had like my two crypto markets that I trade, I would label those crypto. And I've got one strategy that's dedicated to trading the VIX.
Yeah.
So I label that one VIX. So I can
Gotcha.
scan down all my orders
Okay.
across all my accounts, and I can see not only the account number it's for, but I can also see what strategy it's those orders are for.
Okay. Okay. Gotcha. So not necessarily one per account, but because obviously there's different
No,
account
and
structures,
I
like
use the
retirement.
same, I use the same total equity figure for all of them.
Okay. Yeah. Yeah. So it turns into one big bucket, I guess, at the end of the day. Yeah. Okay. Great. Great.
Yep.
Like you said, it keeps it simpler with a slight extra cost, I suppose, right? Because you're probably churning a few more contracts.
Maybe, yeah,
Yeah.
a few.
Not worth
I'm
worrying
not worried about it. It's not going
about.
to make or break my year.
Right.
It's either going to be, I've had years that were 103%. I've had years where I lose money. Hopefully those the years when I lose money are, in the single digits. And when I have an average year, I might be up into the 12, 15 or whatever. All of those are good. I don't really care. It's not going to change my life much.
Yeah. Okay, great. Um, Another sort of systems related question. This is something that I've pulled my hair out a little bit, maybe at times. And and I think it's because there's so many different ways of doing it. And what I'm talking about is um, calculating performance, system performance. And what I'm really talking about is maybe ranking systems against one another to figure out which ones might be the better performing. So risk return ratios, essentially, right? You mentioned a few of them in the book. I think the popular ones like Sharp and Sortino. Um, Van used to use SQN. I still use SQN a lot for looking at both markets and for calculating, uh, system performance. Um,
Hmm.
and I noticed in the book you talk about your own flavor of it because we tend to come up with our own flavors, and there's a lot of different flavors around. You've got one that you call the ETR comfort ratio, which I like the sound of, right? And I was hoping maybe you could discuss that a little bit with our audience, just because it
All
was
right.
something that I hadn't come across before.
Yeah, I was sitting there, I don't know, probably not just one day, probably over a month or so, contemplating return to risk. And, people have asked me over the years, going way back, what's your Sharp ratio? I used to go in and have to compete
Yeah,
as a money manager. I'm in front of a whole investment panel at Merrill Lynch or, Royal Bank of Canada or something, and people are peppering me with very difficult statistical questions and what would you do if this was the case? And how do you invest new money? And all these different questions. And so, I got a lot of questions on return to risk, and each of these committees would have their own favorites, and you'd have to react to it. But when you get into Sharpe, you're looking at volatility as risk. And volatility is a form of risk in my mind, because the human being, if you've got an account that's going up and down 5% a day, that's going to catch your attention as a human being.
Yeah.
So therefore, it's a form of risk. It's positive when it's in your direction. It's negative when it's against you. The other side of risk is just what I call risk, which is the distance from where you are now to where your stop is, and you're going to you're going to take that amount of a loss in dollars or pounds or whatever currency you happen to be in. That is going to be bona fide risk. And so volatility and risk are both easy forms of measuring risk. Well, so all the academics that probably have never managed money before, they come up with these Nobel winning concepts like Sharpe. So you take the returns and divide it by the standard deviation, and they're making equal upside risk and downside risk and saying it's all risk. Well, yeah, I guess it is, but I've never met a client that would yell at me if I made a whole bunch of money quickly. Never. Can we do that all the time? They want more of it. So Sortino came up with a concept of, let's just look at the volatility of the downside. Well, that's a step in the right direction, because more clients and more people, money managers and investors, are going to be nervous about that. Then you get into the
sorry to interrupt you, but for things like classic CTA trend following or any trend following measure, they tend not to look so good on Sharpe, right? Sortino is a little bit better because you get the upside volatility, which you actually want, but you also measure the downside volatility. So at least Sortino got rid of that, but it's still, it's not ideal.
It's still got its flaw. So then you look at things like the MAR ratio, where you take the average return, you put it over the maximum drawdown of all time. Well, that's useful to an extent, but what if the maximum drawdown was 20 years ago and you've had 19 years since then where you haven't even come close to it? That MAR ratio is always going to be using that same maximum drawdown. It's not very dynamic. It's not, as you're evolving and doing better things with your portfolio, you're not really measuring those better things anymore, because your drawdowns are always going to be now lower than what that maximum was. So that's kind of awkward. You could do return to average drawdown, but then, okay, you got a lot of drawdowns. I mean, you spend most of your time in a drawdown. You very rarely are at a new equity high. It might be for a day or two, and then all of a sudden you're into a 0.1% drawdown again.
Right.
So a lot of these little tiny drawdowns back to equity highs are in the average. So how about use the mean or the median drawdown? Well, you could do that. That's a little step in the right direction. So you can see you're sort of always evolving around the problem mathematically, but you're not getting at the heart. And I was sitting there thinking to myself, if I was a manager or as a trader myself, and I really asked myself, when I am the most comfortable, and that's where the term comfort ratio came from, it would be when I'm making new equity highs, continuing to stay above some threshold of drawdown. So in other words, as long as my drawdowns may be 5% or less, or at equity highs, I'm in a period that I would call comfort. I'm not really too much to the downside. Occasionally I'm making new equity highs. Doesn't have to be every day. Sometimes I'm in between the equity high and that 5% drawdown, just hanging in there. That's okay. I'm comfortable. So let's rate, and I don't know why I thought of this, but it was sort of like I went back to my freshman year of engineering school and integral calculus. And I was thinking to myself, how do you measure the volume of a lake with an uneven surface underneath it? Well, if you broke the lake into little 1 foot squares and measured the depth of every one of those 1 by 1 squares and then added up the entire collection of 1 foot squares, you would have the volume of the lake roughly.
Right.
And so I was thinking to myself, well, how about if we took every day that we were in these comfort periods and just added from the point at which I am at comfort, which would be the 5% down, sort of imagine a bar chart up to where we are now and take that amount of return and add it to the next day and the next day and the next day, and that becomes a comfort period.
Right.
That's the numerator. Now, when am I most uncomfortable or in a state of discomfort? That
Yes.
would be when I'm starting to exceed a certain threshold to the downside, or when that lasts longer than probably about 6 months in my case, but you can make it any number you want.
Yeah.
That would be the discomfort period. And you do the same thing from the point of discomfort down to where you are now. You would measure the magnitude and you would keep measuring it every day for 6 months and beyond if necessary. And just keep adding it and adding it and adding it. And the longer you're in the discomfort period, the more that gets added to the denominator. So now over time, let's say you got a 10-year simulation and 20-year simulation, and you take all the comfort periods and put them in the numerator and add up all the discomfort periods, put them in the denominator, you have comfort over discomfort. So you have a comfort ratio. The
Yeah.
higher you can make that comfort ratio, if you're comparing various strategies, it seems to me you're getting yourself closer to what a trader really is looking for, historically speaking, realizing that the future is always different.
Right. Right. That's the thing. Well, especially with something like MAR, like that max drawdown, right? They say that your biggest drawdown may be in the future, and a lot of times it
Maybe.
is.
Yeah,
Um,
I could argue depending on what you did with your strategy,
yeah.
for instance, say cutting the leverage in half,
Right.
then your maximum drawdown in the future might never be what you've seen in the past. So
True.
there's lots of, extraneous inputs into that statement that may or may not be. Yeah, if you're doing the same thing you've always been doing, yeah, I've heard that as a trader many, many times, and I do believe it. Your biggest drawdowns ahead of you. Always be prepared mentally. When you're
Yeah.
doing a historical simulation, what I like to say to myself is if I see a drawdown on that simulation of, say, 10%, in my mind, I think 20. I
Yeah.
double it.
Yeah. Yeah. I
Just to
often do the same. But and I wonder if you've got any views on this. Like um, I find that a lot of the times I'm focused a lot on risk. So on the risk side of the equation or the left-hand side of the histogram, if you're looking at like the histogram of returns. Um, because if we can look after the risk, then the profits can look after themselves. That's kind
there
of
you
like
go.
the general idea, right? As long as we're managing that left-hand side, then we can control essentially not going bust or not hitting a point of drawdown where it's too much. Now, but I think sometimes by focusing so much on the risk, you're not focusing on like the profit side. It could mentally wear on you just because you're looking at risk all the time. I don't know if you ever come across that, or have you ever like is there ever just like, oh, I'm always just looking at risk and drawdown, and as opposed to like where maybe just like the positive side of this could be going?
Yeah, there's a tendency. Some people have accused me of emphasizing risk so much that I'm not producing the kinds of returns that some people and traders are looking for, to become billionaires
Right.
in the next 5 years.
Yeah.
I'm not looking to be a billionaire in the next 5 years. So I've got a different objective, which is why I'm so big on everybody doing whatever it is they need to do to satisfy their own objectives. Don't try to trade like me, try to trade like you should be trading.
Yeah.
I'm a big proponent of that. I don't think there's one strategy for everybody. That's ridiculous because everybody's different. But I do think that I could mathematically simulate that some of my risk reduction techniques are going to mathematically reduce returns over time. So it's a trade-off for me of, if I'm going from 15 historically down to 14, but I've cut 2 points off my maximum drawdown. So I'm getting twice as much drawdown reduction percentage-wise as I'm getting return reduction, that's a good trade-off for me, but it does tend to limit my returns.
Yeah.
There's no doubt some of the math behind some of the things I do to reduce risk are directly going to go against returns. But if if you take the attitude that the markets with their movements are going to provide you your returns. And your job as a trader is to go along with the ride. You don't have any control whether gold makes continuing new highs for the next year and you get to ride it to the sun and make a bunch of money, or whether it's going to reverse today and
Right.
start going into a bear market and be in it for the next 4 years. I have no clue, and I'm prepared for both. I don't really care. And I think that that's a better attitude to take than to try to emotionally involve yourself in gold's got to continue to make new highs for the next year because of the following 10 reasons. And then position yourself that way, and you get emotionally attached to it, and you wake up in the morning and wonder what gold is doing. Uh,
Right.
that's got a lot of pitfalls in there. That
Yeah.
would be another whole interview in itself.
Yeah, yeah, for sure. There's a lot of people that do that, I think, right?
Yeah,
Because they've
a
got
lot.
a large position in only just a couple markets, right? Um,
Well, as Tharp used to say, you could either trade the markets and because you like the excitement and therefore you will get excitement, or you could trade the markets to try to make money, in which case you could try to do that. The excitement levels might not be there if you're making money, but it's a lot easier ride to take, I think.
right.
So,
Yeah, and there's a payoff at the at the end of it.
yeah.
Um, So, which is essentially comes back to beliefs a little bit. So,
Hmm.
so I wonder if you're up for it. I thought maybe we could try to just workshop a bit of a system. So,
Sure.
I'm just curious because you actually talk through systems design in All Weather Trader, and obviously you've been through it numerous times yourself.
Seems like thousands.
Yeah, yeah. Um, but yeah, how many ways can we skin a cat? But maybe we can come across something that's a little bit different. And I'm just, I'm aware that in a way, I've got the cook in the kitchen and or the maybe the Michelin star chef. And so maybe I can get you to just kind of show us how your approach is, not really for the outcome of whatever the system might be, but just the thinking behind what goes into it. And so often it would start with beliefs. And so there's beliefs, and then there's also a little bit of data usually too. And so Perry Kaufman, you probably know him or know of him.
No, of him.
Yeah, he talks about signal and noise, and he's got some mechanisms that measure noise. And the long and short of that really is that some markets are noisier than others, and the markets that are noisier tend to be those that are more mature and there's just more activity. And the noisier markets have smaller basically they're noisy and um, they're noisy in a way that it's difficult to make money in a trend following style sort of way, whereas then you've got like the maybe less noisy, less mature markets. These days I think maybe crypto would even fall into that, where you get these large trends that just sort of persist and they're less mature, they're maybe even less liquid, but you get those larger moves. And so I've seen another study, I think that you talked about as well, that, markets tend to go sideways more than they are directional.
Mhm.
So do you agree with that? Or like, would you say that's a belief or actually, no, that's backed by data. So we can say that, that's actually a fact.
Perry has done a lot more work in that area than I have. With the 35 or so markets, maybe 40 markets now, that I trade that are fairly well-known markets, some of which are more institutionally dominated, like currencies and debt instruments and equities and that type of thing. And then the kind of smaller soft markets, orange juice, coffee, cotton, those types of things. They're
Yeah.
liquid for me, but they wouldn't be liquid necessarily for a CTA that is
Yeah.
sitting there trying to manage tons of money.
Right.
Back in the day, I was having a hard time trying to, move very much of a position of orange juice, let's say,
Yeah.
you're handling 600 million. So I would think that's a belief, but it's also something you could measure. So if you take a bunch of markets and you try to label them ahead of time as established or not, and then you could take an indicator that would be real simple, like a Keltner, a Bollinger Band would be another one, Donchian to a certain extent. You could do that, and you could set up an indicator over some time period that you wanted to be interested in. 21 days is roughly a month of trading days.
Yep.
So I use that a lot just because it's about a period that I care about. Anything less than a month, you're kind of getting into the heavy trading and a little bit more work. And some people like that, so that's fine. But if you think about those indicators, they have bands on top and bottom. So every
Yes.
time it makes an excursion through that top band or through the bottom band, you're now out of the noise and into the signal. And so through the top band, you're going long. Through the bottom band, you're going short. If you're inside or spending a lot of time inside those two bands, that would be termed as sort of sideways. You're in the noise. And you could certainly just run a market through 20 years of data and total it up and see what percent is noise and what percent is signal. And pretty easy to do mathematically. You could do it with a spreadsheet.
Yeah. So if you were to, and I know that this is maybe not necessarily what you focus on a lot of time, not necessarily your wheelhouse, but for like, I'm thinking about the sideways markets. And if we're in sideways markets for longer periods of time than we're in trending markets, and we know that there's liquidity in some markets, but there's also a lot of noise. Could we design a system that would mean revert some of those noisy markets, maybe using
Sure.
those same tools, right? Those, whether
Okay.
it's Donchian or Bollinger or Keltner.
All
Um,
right. So let's do that. First thing I always do is we need a buy sell engine. So, and that's what most people look at. If you look at a new trader, all they're ever doing is always looking at, um, they're looking at trying to um, indicators. So let's take a simple one, which is Donchian. I'm going to make this really super simple. So Donchian, let's say we don't want to trade every day, but we'd like to pick up small swings, maybe 3, 5 days. Let's use a 21-day Donchian and say that the top and bottom bands of that, so basically a Donchian is nothing, look back 21 days, highest
mhm.
high, look back 21 days, lowest low. That's the range of all prices within the last 21 days. So it's pretty easy concept to understand. So let's do a mean reversion. And what we'll do is we'll have a buy sell indicator. So to get into a position, let's sell every time we're above 80% of that range. So we'll measure the range in points, let's say,
Yep.
and then we'll have an indicator that's 20% down here. 0 is the low, 100 is the high, 20 is going to be where we're going to buy, and 80 is going to be where we sell. 50, which would be halfway in the range, will be neutral. So let's make our buy sell engine. We'll sell it every time it gets 80 or above, and we'll buy it every time it gets 20 and below. Our
Yep.
stop loss when we're buying on the 20 or belows is going to be the actual low itself. So if it breaks out of the channel, now we have a trending down market. It's no longer in a sideways. So we're going to take our loss and maybe go short if we want to. On the other side of it, if it's above 80, we're going to be going short, trying to expect it to come back to the median. And we're going to put our stop loss to buy the stop as above the high of the Donchian. So now we've constructed a simple concept for a buy sell engine.
Yeah.
So we would go ahead and program that into either our trader workstations or our platforms that we use at our broker, or we program it into a computer. a TradeStation, Thinkorswim, or any of these, you would try to get that all structured. Next up would be position sizing.
Yeah.
So what I would do then is, so we've answered the question of where we're going to buy and sell and whether or not we're going to buy or sell. So the next question is how much are we going to buy or sell? So kind of depends a little bit on, you didn't specify how big the portfolio was or what your objectives were or anything. You nailed me down into an actual strategy without a
Well,
whole lot
we
of,
could cover that. Um,
well, how big's the portfolio, for instance, and how many markets are we going to trade? And
yeah, I would say for the just to keep the numbers easy and small, or smallish, right? If we had a portfolio size of 100,000 and we need to decide how many markets we think we can actively trade, sort of at one time within that.
all right, so let's make it simple math. 100,000, let's say that we're going to have 10 positions and they're going to be, say, a diversified futures portfolio. So we're going to have like one grain, one meat, one precious metal, one energy, one stock index, one debt instrument, and so on. And so we're going to do that. We could easily figure out 10 that would be different. So for position sizing, we would ask ourselves the question, how much would I be willing to lose on a trade if it goes against me as a percent of my 100,000?
Right.
And, you know, depending on your strategy, let's make the numbers easy again. Let's say 1%.
Yeah.
So if we got a $100,000 portfolio, we're willing to risk on any trade $1,000.
Yeah.
We know now from where let's say we're going to buy at 20 and catch the next upswing in this sideways market. We're going to buy at the 20, whatever price that happens to be. We know our stop loss is the Donchian lower channel because we defined our buy sell engine.
Yeah.
That gives us a very definite number of points that we can translate with one contract into dollars. We know that we can accept $1,000 worth of loss on any one trade. So let's just make up some numbers real quick. That the risk on a trade for a gold contract, which is easy math, is going to be 1 point, and 1 point is going to equal $100. All right, so
Okay. Yeah.
$100, and I know I can spend $1,000, so I'm going to do 10 contracts.
Yeah.
So now I've
Right.
just sized the order.
We got our position size for that example order. We know how much that's going to cost us if it goes against us. We know exactly where the stop's going to be. We know what markets we're going to trade.
Right. Now, just as a side example in the same gold contract, let's say volatility had doubled.
Mm-hmm.
Gold's going nuts now. So
Right.
the noise bands are getting wider. So the distance from 20 down to the stop is going to get wider.
Right. So it's
So
almost
let's say our risk on the trade for gold becomes, let me say it's 300 now instead of 100. So the distance between where 20 would be, 20% of the range, that price down to the low of the Donchian is going to be equal to about $300 per contract.
right.
And I can only spend 1,000 still. That
Right.
stayed the same. 1,000 divided by 300 is 3.33.
Right.
Can't do 0.3 contracts, so you'd
Round it
round it
down.
down to 3. So now instead of doing 10 contracts, you're doing 3. So what just happened there? The higher the volatility and the higher the risk per contract, the smaller the size of contracts. And vice versa, the lower the risk and the lower the volatility per contract, the more contracts I take on.
Right.
So the position sizing is actually going in the opposite direction to volatility and risk. And I think that's appropriate. It then gets your portfolio size so that everything in the portfolio is sort of biting off the same amount of risk and the same amount of volatility. So you truly do have a portfolio. You don't have one thing and 9 other things. One thing that drives everything and 9 others that don't make a difference.
Right.
Okay,
Right.
so now we've got our buy-sell engine. We've just now done our position sizing and we're pretty confident that that's going to work the way we want it. So what do we need to do from there? Now we need to go select our portfolios. So the way I would do that in the case of our example is I would just look at, I don't know, the CME or go into one of your platforms that you trade on, your broker platform,
Yeah.
or even some things like barchart.com, those types of things. Got a lot of ways of doing it, and just start making up a list. And I would do it as a human being. I would not run a correlation study. No need. Um, all right, I'd say, wow, there's these things called grains out there. Let's see, there's soybeans, soybean oil, soybean meal, there's wheat, there's corn, there's um, canola up in Canada. So you got a lot of different types of grains. Which one should I pick? Well, which one has the least amount of margin utilization? Looks like it actually makes some moves over time. If we're looking to try to do a mean reversion, maybe we don't want moves. We want markets that are kind of stable and not going anywhere because we're going to be trying to mean reversion this thing. So
Right.
let's say, hey, corn's pretty deep. You got a reasonable size contract. You got a micro contract that you could do if you really wanted to. And you also have the ability to have government sort of price controls or support underneath it for all the things like gasohol, where they
Mm.
make this alcohol out of the corn. So government comes in and sort of puts a floor on it a little bit. That kind of makes the market a little sluggish, maybe. Yeah, let's pick that. So item one is going to be corn. And then let's say we look over at the meats and we realize, let's see, there's feeder cattle, there's live cattle, there's lean hogs. Lean hogs got a little smaller contract in there. Why don't we do that? Okay, so now we got a meat in there. Currencies, well, we look at a bunch of those and it turns out is the contract sizes and all that. Maybe the British pound has got a little bit smaller contract size, so we can afford that a little easier. So let's do a British pound in there. And that's what I'd be doing. I just fill up the 10
Yeah.
positions by using human judgment and realizing that when it really comes down to it, does the British pound really care what the Standard and Poor's 500 is doing? Or does the corn market really care what the gold market is doing?
Right. Yeah.
They don't
So
care, all
soybeans,
right?
lean hogs, all of these things are pretty separate. I mean, there's a
They're
dollar
good.
element to it, but still,
And if you're going to trade orange juice, does orange juice really care what the U.S. Treasury market is doing?
Yeah.
No, it cares more about whether there's a hurricane coming across Florida or a frost going to occur in Florida or something like that. It
Right.
doesn't care what U.S. Treasury bonds are doing. So if you're trading U.S. Treasury bonds and orange juice, you got two different animals there. That's diversification. And so you put together your 10. So now you know what you're going to trade. The markets are all set. You've got your indicator. You've got your position sizing. I probably would then move to simulating at that point, and I would come up with my magic $100,000, and we would create either a spreadsheet or a small program that would then run that, measure the Donchian each day. What's 80%? What's 20%? What's that equivalent to on price?
Yeah.
If I'm down in there, that's now my buy order. How much should I do? Do the calculation on risk, do the calculation on volatility if I needed to. Figure out, okay, I'm going to do 7 gold contracts at this price, good till cancel on a limit order. And then as a child order, I would say with a stop of 1 tick beyond the low of the Donchian.
Right.
There's my order. I'm already ready to go, and I would simulate that. If it looked like it was a great diversifier against some of my longer term strategies that I might be running with that same $100,000 and maybe those same 10 markets, but with a completely different, could be a 21-day moving average on those same 10 markets. Again, with some form of risk control, some form of position sizing, everything else. I'd run them, side by side if I wanted to use the equity two different ways.
Oh,
Uh,
okay. That's interesting. So yeah,
yeah, Yeah.
Could you talk a
And
little bit more about that, running it side by side using the same
well,
method?
what you end up with then is a simulation that's a bit more complicated, but what you end up with for the mean reversion strategy we just created is I would run the historical simulation of just that, see how it performed by itself. And I would be okay, since I know I'm diversifying against other strategies, I would be okay if it just produced a few percent return even,
Right.
if I knew that it was going to make money during sideways periods where I know some of my other strategies are definitely going to lose money. So Lawrence Bensdorp in his magical book, I think it's Automating Your Stock Portfolio, called it Filling the Potholes.
Yes.
The
Filling potholes.
potholes,
Love
it's
that.
such a vivid image in my mind. I love it. And I stole it from Lawrence. I give him full credit. Lawrence, the filling the pothole, you got the track record that wants to be a straight line, like a road going up the mountain. But unfortunately, get these drawdowns in there. They're like potholes. And that's not fun to drive on. But if you could come up with strategies that tend to make money during those periods, you're going to squeeze that pothole closer to being a nice smooth road going up the mountain.
Yeah.
So what I like to think of it as is a mean reversion would definitely be a type of strategy that would tend to make money during sideways action because the market's not going anywhere and you're selling the highs, buying the lows, and it keeps doing that over and over again. And it does, sideways markets tend to be there more than even trending markets. And so off you go, you're picking up this nice little return, but it's more important to know where are you picking up the return. If
Yeah.
you're making 3-4%, that doesn't seem impressive. And a lot of traders would look at that and say, "Oh, I'm not going to do that." But what they don't realize is if it's making money during the same exact periods where your other strategy is losing, again, you're
Exactly.
squeezing that return the risk the right way. You're not hurting your returns that much because you are actually increasing your returns during the period when your other strategies are losing money and hurting your returns.
Right.
So by squeezing that, you're actually compounding out decently, and more importantly to me, you're improving your return to risk ratio.
Yeah.
And
Yeah.
so what I do is first run the mean reversion, see what it does, see that it makes money during sideways periods. So I
Sure.
would definitely go and look for markets that had sideways periods, and I would look at the return potential from this strategy during those exact periods. So that involves tedious work, believe me. You're now taking the track record and getting a spreadsheet or whatever, and you're looking day by day at the data
I was gonna say, would you do that manually, like
manually.
visually looking at the chart and deciding, yeah, that's what I mean by sideways?
I would, I
Or-
would, I would turn on my own private. I'll do a plug for my public playlist on Spotify. It's by Tom, which is my
Okay.
name after all. If you want to search for it, I believe it's called. In fact, I can tell you exactly what it's called. I think it's Smooth Chill Instrumental Jazz.
Oh, nice.
Uh, and it's
Yeah,
got
because
like 6,000 tracks or something. I'll tell you in a second what it is.
wow.
Yeah, Smooth Chill Instrumental Jazz by Tom.
And so
I
instrumental is great because you don't get words coming in your
don't
head.
get
You're trying to
words, nothing to
concentrate.
distract you.
Yeah.
And it's a little on the smooth side. It's chill.
Yeah.
So I am Mr. Serenity after all. You
It's
have to try to be
it's very
chill.
fitting. Yeah.
And I would sit there and I would close the door to my office. I would put on that and I would sit there with the tedious job of for the next hour or two going through day by day and seeing that this mean reversion strategy did what it was supposed to do during the periods that I wanted to do what it's supposed to do. That during the sideways periods, I want it to make money. It might not be 2 or 3% during those periods. It might be 15.
Yeah.
Got to make money during those periods. The rest of it is interesting also. How did it lose money? Well, mean reversion, if stock market's going crazy upward and every time I get up to the 80, I short it and then I
Yeah.
get stopped out as it makes new high. Well, that's to be expected. And I'm going to lose money during those periods.
Right.
There, I want to have my trend follower come in and kick it and make a bunch of money trend following
Right.
wise. So this is where you get the logic, symbiotic logic of the two strategies coexisting and smoothing everything out for you so that you don't care whether it's an up market, sideways, down, you got something to cover it all. Something is actually trying to make money during that period. That's why I have 7 strategies, and I keep looking for other ones. I keep thinking of how am I going to do the next step here, and got some ideas. Haven't got anything, locked in yet. But as I get ideas, I pull out Word document, and I start typing, and
Great.
I think I need something that tries to make money with these types of markets in this type of condition, and I want it to be a little bit more on the intermediate term side, not real long, not real short, that type of thing. I sort of free form my thinking,
Yeah.
and that becomes the kernel of what I might start researching when I get to the point where I can spend the time working on it.
This is great. This is what I love doing. And so thank you so much for running through that. I mean, that's
One
you
other thing I'd add, you asked a question that I didn't really answer well, I don't think, is what
okay.
do you do to look at both of the strategies? We talked about having the mean reversion, which we just custom designed here. And then I mentioned, but that might be making money when maybe the long-term trend following is losing money. So let's say we already have that long-term trend following and we have the short term. This is a critical thing, and most people do it wrong. And a lot of trading platforms that you look at will do it incorrect, in my opinion.
Okay.
They will do the simulation of the mean reversion on 100,000. Then they'll do 100,000 for the long-term trading strategy. And then they sort of in their mind just dump them together.
Yeah.
Nope, can't do that.
Yeah. It doesn't quite work like that.
What you got to do is go way back up to the beginning, and you got to base both of those strategies on 100 grand. This one over here makes money, this one loses it. So you still got 100 grand.
Right.
We go down a day and we run the programs with what? We don't, because this one lost money, you don't start using 99,000 for this one and 98, 97, and so on and so forth, because the portfolio is still worth 100,000.
Oh, I see.
So what you got to do is add up all the strategies every day, figure out where your equity is, and then base every strategy on what the new equity is. And
Okay.
what you're going to be doing is rebalancing your portfolio internally every day,
Yeah.
which is an automatic improvement in your results. I've proven it to myself so many times. It's one of the free things in trading. If you can
Hmm.
simulate using multiple strategies and combine the equity every day and run it that way, which a lot of trading simulation packages do not do, sadly. Um, I do believe that that's the proper way to mathematically do it. And that's the way you would do it in the real world, right? I mean, if I'm running my stuff this afternoon and my equity is 100,000, I'm going to be basing all my strategies on my $100,000 equity. I'm not going to have some kind of a magical equity for my counter trend trading or my mean reversion trading or my long-term trend following trading, and then just keep track of that equity over and over again. And then they get out of balance completely because one is gone from 100 up to 150 and the other one's gone from 100 down to 90 or 80, and they're no longer balanced. So I'm going to
Yeah.
just balance them every day by just using the same equity for every strategy.
Okay.
And
So that's
if
that's
you
a
can,
that's a really good distinction. I mean, that's a because yeah, I've not heard that I'm not sure I've ever heard that before.
yeah,
So
you don't hear it a
combining,
lot, and I look at a lot of these simulation packages that are really simplistically put together. They tend to be a simulation package for one strategy.
yeah,
Multiple strategy simulation is a bit more of a heavy duty computer operation because you got a lot of data across a lot of strategies, and you have to not just blaze through the database, which is the easy thing to do. And
yeah,
it's what all the computer jocks. I've had computer jocks work for me at Trendstat. I had at the peak, I was a computer jock, an engineer, and we had 3 other people that were programming. 4 of us out of 10, 40% of the company was computers. And the easy solution is you take the database and you just go zip right down it. And that's what the computer person wants to do because it goes faster that way. And
Right.
he knows it.
Yeah.
And I know it. And I tell them, no, you can't do that. You got to sit here and you got to have all these databases open and you got to do one day at a time. And then you got to add it up over into this database. And then we got to notch down a day on all of these and go back and we're opening and closing databases. Tom, do you realize that's going to take a lot longer to do? Yes, I do understand that, but that's the way you got to do it.
Yeah.
And I used to have battles. I think they finally, in the end, finally started agreeing with me when I proved it to them by going through zip, 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 and then add it all together versus doing it day by day. And we saw what a difference it made in the numbers. And
Yeah.
finally got them on my bandwagon, but it took it took a little while of convincing my own people to do that. But
Yeah.
a lot of the packages out there you'll find are very one strategy oriented, and then the tendency is to do several strategies and then take a spreadsheet and take the equity curve on every strategy and just sort of add them together or something, and that's not going to give you the same answer.
Yeah, yeah. I've seen, I've done that. I've seen that for sure. And yeah, it's a slightly different approach because essentially what you're saying then is that the big number at the top right of the screen or wherever it is when you're a trading platform is basically just your overall equity for as many accounts as you've got all wrapped into one.
Right.
Um, that's the number that you base that equity figure off of. So if it's a 0.5% risk that you talked about before for some of your strategies, no bigger than 1%,
Mhm.
then you're looking at that at a strategy by strategy level, but it's based off of the overall equity of the entire portfolio. Is that right?
Correct.
Okay.
hmm And
Okay.
every day it's the same thing over and over again.
Do you also measure on a strategy by strategy basis which ones are actually performing each like at one time so that you can tell whether like let's say in this example here we've got our mean reverting system that we just designed and it should work well in sideways markets. So we get a sideways market or a series of them and we see that system doing well, and then maybe the trend following system isn't doing so well, and then we combine the two and we can see that okay, yeah, this one's netting off a bit, but overall we're heading up. Do you look at them independently like that?
I could have, I did that in the old days. I probably could spend more time doing a little more automation in that area and do it. I kind of am so experienced at this point, I can look at the screen and kind of see what's going on and know just how my orders are running, which ones reversed, which ones stayed with the position. And
Okay.
I can look at certain markets and say, wow, that market has got a big number of green. And then I look over on the chart, okay, yeah, my long term is kicking and my short term's kicking the same way. Yeah, that makes sense. You know,
Awesome.
I can kind of just glance down the screen and almost know which one's kicking which way. And um, I try to keep it simple. Lawrence, to bring him up again, runs 55 strategies at the same time using computers again.
Yeah,
And he's like the
you'd
the
have to.
ultimate multiple systems trader. But to me, when you get too large, you lose a little bit of like Tom's brain in the picture. I like the fact that I can get a little bit more intuitive sense of what's going on. And I'm very able to step in and do things manually. We're working on the development of this trading platform for the last, what, 4 years and 10 months now. It still isn't ready to even go to beta testing yet, although we're getting close. I
Good.
was doing some simulations last night that were actually working for a change, so that was good. But the the bottom line is when I look at even automating to the extent that I do with 7 strategies, you get a certain amount of detachment from the action of physically putting those orders in manually yourself.
Yeah.
Because then you really know what's going on. Now, there's good and bad with that. I just don't, I've done this 50 years. I really don't want to sit here all day long and with my mouse moving stop orders around on the screen. That there's about 100 things I'd rather be doing with my time, but to a
Yeah.
new trader, that might be a great way to get a feel for what's going on. But when you start automating 55 different things, you might be taking it to the point where you're losing a little bit more touch with what's going on. So I'd like to keep it to say 10-ish or less. I
Yeah.
think I could handle. I think you start getting up into the 20 and beyond. I think it might get a little complicated for my brain. And if I ever had to step in the case of the automation not being there and I had to do it manually, now I'd be looking at 2, 3 hours of work to try to do stuff. And
It's a very good point, right? Technology
yeah, I don't
doesn't always
need to
work.
do that.
If the automation has a problem for whatever reason, and you're left with a bunch of open positions and a bunch of open orders waiting to be triggered,
Updated.
you know,
Yeah.
and if it's too much, what do you do in that case? And my almost if it's too much, if it's, 100 different systems, each with 100 different markets, now all of a sudden that's a lot of things to look after. And
We
you're
had
basically gonna have to go flat and cancel everything and figure out what and then start over again in a way. Like that would have been
uh,
my go-to from an automation point of view. Uh,
we had our platform go down for a few days when there was a communications problems between the broker and the platform. And so I ended up having to go manual for about 2, 3 days. And it was taking me a good 2 hours to get everything done.
yeah,
And it normally takes me about 40 minutes or so.
right.
So it was a significant difference to do it
But
manually.
but you could still do it,
I could still do it.
right?
I'm proud to say I made it through the period and we got the communications working again. And now I'm back to my 40 minutes and I'm trying to make that go to 15 or 20.
Yeah.
Uh, and we're getting closer, but we aren't quite there yet. We're getting closer.
Well, I mean, that's great because the system that we just sort of went through, the one that you just kind of, riffed off of there and
Made up.
redesigned. Yeah. By the way, how do you feel about that? Do you think that would be a
I bet you it
full
would
system?
work I
Yeah.
bet you it would have in a sideways period particularly, I think it would work fairly well.
Yeah. So pair that with a trend following system and you
Yeah.
might have a nice pairing. What I like
Yeah.
about it is, we define some of the objectives or the limitations or constraints, right? If it's 100,000, then how many markets could we run? And then you basically go through different asset classes within the futures markets and pick one. And now you're getting some diversification amongst markets. You're getting diversification overall because it should be a system that's diversifying against something else, as opposed to maybe just running on its own. And so, we covered, an awful lot of stuff there. And, a Dunkian channel, we could probably have used Bollinger or Keltner. I know that you're quite comfortable with all of them. And
Yeah.
as you pointed out before, there's a built-in volatility um, element, right, with all of those. And with Donkian, as that market, as those bands go wider, that's just telling you that the volatility is up and it's auto-correcting because we're position sizing that way.
Right.
So
So more
that's got,
volatility, wider bands.
yeah, all of that has all of the elements that I would normally look for when I'm building in systems and that sort of thing as well. And so shameless plug here, we're actually running a systems development workshop in mid-November here. So if anybody's interested in taking what we sort of described here and turning it into a system. So this was great because we get to do the conceptual side of figuring out, what sort of thing do we want to run. And then you have to go back and you could do that away from the screens, right? And that's you get to enjoy the ride by. We could be having this chat over a beer if we weren't a few thousand miles away. And then you can get into your office and the computer and open up the screens and say, okay, now I need to go in and do the work and get on the smooth, chill instrumental jazz and start doing the researchy side. So what we're going to do in the workshop is some of that actual work. And I think, the tools that you have available now are so much different than you probably had when you started out. You were probably doing it manually on a piece of paper for time. Um,
And a calculator that add, subtract, multiply, divide.
yes, yeah.
Do you remember the SR10? It was $150 when it came out, and it was about
Is that a
yay
TI?
big. And all it did was add, subtract, multiply, divide, equal sign, and some numbers. $150.
Wow.
That was in 1974. I had that.
Yeah. Well, and And yeah,
PC, my first PC, personal computer,
yeah,
where I started being able to automate some of this was
yeah.
in 1980.
Oh, that's pretty good going. Yeah, I bet it was big.
Yeah.
Bigger than your
It
iPhone
filled up the
or
space. It actually helped heat my office.
yeah,
And you had these old tube-built monitors, that also created a lot of heat. None of these thin screens.
yeah,
And the screen wasn't that large, and it was pretty much black and white or some form of that.
yeah. The LCD, the
Yeah,
liquid
it
crystal.
was really rudimentary. And
Yeah,
yeah, I've seen a lot of evolution over the years in trading,
it's great.
50
So
years.
because what we're able to do now in a web browser with, I mean, we're going to use TradingView for this workshop because it's the most accessible thing. All you need is a web browser,
Sure.
and you can use
Yeah.
it. They have a free tier, and there's a coding platform in it. And you can't do everything, but if you're just kind of getting involved and you want to figure out how can I start to play with some of this stuff, it's great because you can code into it. You get all the charts, all the data is there. You don't have to do all of that manually, and you get to see on the chart where buys and sells go, and then figure out, that research exercise with the jazz music in the background, it'd be a bit easier because you can actually see on the screen where the trades are happening. Anyway, so we're gonna be going through just that kind of stuff, and I love it. I think that's great. So thank you so much for going through that. I'm pretty interested. I'm gonna basically straw man that system out and probably pull it together and see how it
There
looks.
might be one other filter we need to add to the mean reversion then, and it
Mm,
may have something to do with what kind of trendiness we're after. So we may want to wait until the top line is pierced down, but still above 80 to put on a mean reversion when you're in a trend. So in other words, if you're in an uptrend, you may want to buy the 20, but you may
yeah.
not want to sell the 80.
Oh, gotcha. Yeah.
So there may be a little bit of that going on that we'd want to add to make it work a little better. And I think you want to match up your long-term trend following. So if you're using 21 days, let's say, for the mean reversion,
Yeah.
uh, Keltner or Bollinger or Johnson, you might want to use a similar type of indicator to do your long-term trend following on the other side. Keep
Gotcha.
it in a similar time frame.
Yeah. Okay. Awesome. Um, I'm aware that we've been on for almost 2 hours now. How are you doing on energy and time? Because I can keep going.
Oh,
I
I'm
also,
I'm doing fine. I've got nothing after this.
okay. People are still sticking with us, some people at least. So that's a good sign. Maybe if we could just do a little bit more, I've got a few things that I would love to just get your thoughts on, really.
Sure.
One of them is you mentioned crypto a while back, and I know that
Mhm.
you've got one of the systems that you run is I want to say it's Bitcoin versus Ethereum. Is that right, or is it
No, I do both contracts by
se-
themselves, long or
separately?
short, using
Okay,
the three indicator 9 day package. So Keltner, Bollinger, Donchen, all on a 9 day time parameter. And first one hit, I go long or short all the
great.
time. I'm either long or short. Right now, I'm long both.
Okay. Yeah, because Ether's gone a little bit sideways, it looks like to me, but yeah, I could see how it's probably pierced. So yeah,
It's somewhat sideways, but it's actually been to the upside for about a couple weeks now and hasn't really followed through as much as Bitcoin has. But
yeah,
Bitcoin is sort of dragging it along, kicking and screaming. And so both of them are still to the upside. The Ethereum stop sell would be a lot closer to where the market is than is the Bitcoin stop.
yes, okay, gotcha. And you're trading via the futures contracts, is that right? Like
Yep.
the
And the
CME?
reason the reason I do that is you can't really easily short a crypto. You can do it at some firms, but then there's that question of
Yeah,
like the FTX risk type thing,
that's it.
how much the firm's viability is at risk if the markets were to go crazy and they're allowing short sell, and then the firm is illiquid and you lose all your money there, and there's just a lot of issues. So having the futures markets is an easy way to go long or short. and you have an exchange behind the contract.
Yeah.
So to me, it's a no-brainer. The tax rules are 60% long-term, 40% short-term in the US, which affects me. And
And it's
crypto,
familiar.
if you're doing buying and selling crypto, it's all short-term gain, which is a higher tax bracket.
Mm.
So to me, it's a pretty no-brainer to use the futures contract to get the exposure.
Yeah. Okay. Interesting. Yeah. I mean, obviously you're f very familiar with futures anyway. It's just another futures contract in a way to you, I would
Yes.
assume, right? So,
Yeah. And it trades through the CME, so
right.
they're very, very respected and they got their act together really well. So I'm a very big fan of the CME.
Very good.
So even 40 years ago, I was a fan of them when they were the Chicago Mercantile Exchange. I still proudly wear one of their t-shirts when I'm out in the yard pruning that I got
So put
free at a
together.
conference someplace, but somebody handing it to me and saying, Tom, here, have a free t-shirt. So I still have a free CME, Chicago Mercantile Exchange.
Brilliant. Brilliant. Um, the okay, a little bit on lifestyle
Okay.
because you are Mr. Serenity, and enjoying the ride is actually one of the most important things because it's so easy, I think, to get caught up in the trading and the research and the doing of the thing. Um, so it be to be able to enjoy the ride, you've organized yourself and your trading systems for that. So in a way, it's a lifestyle design in which trading is a piece. Um,
Correct.
how do you, besides like say the 40 minutes or let's call it an hour, the hour that you sort of that you carve out of your day, um, and then of course you have chats with guys like myself and that sort of thing as well. But do you purposely sort of like ensure that you're getting in exercise, outdoors, fresh air, that sort of thing on a daily basis, or how do you tend to manage it?
I try to like, well, today's a good example. I'll just run through the whole day. Got up, had to set the alarm for you. You should be very
Sorry.
honored that I set the alarm. My wife and I don't like to set the alarm. We're retired. We like to wake up when we wake up and have a cup of coffee in bed. And sometimes I'll put on the smooth jazz or some spa music, and we'll watch the sun come up or
Nice.
admire my landscaping out back. But we did that. We had a quick breakfast. I checked out my overnight fills. So that took me 10, 15 minutes tops. Everything was fine. There was nothing that was out of the ordinary. I didn't miss anything. I didn't make any mistakes, or, the broker didn't make any mistakes. Everything was as expected.
Yeah.
And then,
Is that part of the usual routine? Like
yeah, I
a quick
usually
sanity
will,
check?
when I'm done with breakfast or something and I arrive in the office, which is a different part of the house, I'll actually fire up all the machines and just do a quick glance of what happened overnight.
Yeah.
Where are we now? Is there anything that, I've had situations where the platform will roll all of a sudden. Let's say, I think the other day there was something that it was a copper contract that for some reason got rolled in the system to April, and April doesn't trade anything. December is where we should be trading. So
Right.
I had to manually override it and say, no, I don't want that order. I want the Decembers. And I had,
Gotcha.
to, make some adjustments. So the human being can spot stuff like that and correct it and then get back to the programmers and say, okay, why did this happen? And how do we make sure it never happens again? Those types of things will show up from time to time. So I kind of view myself as sort of an alpha tester of this platform we're consulting with, and I just try to spot things that are not going correctly and then feed
Yeah.
that back to them so they can improve the strategy, improve the platform.
That's
So I
great.
got that done. Then I signed on with you, tested my lighting. You saw me running around changing some lights.
Yeah.
Got myself blacked out on either side, and I've got a door closed over here. And I think the lighting looks better now because there was some sunlight coming off of the wall opposite, and it was reflecting back on this side of my face.
Yeah.
And I
It,
saw that and I was wondering, I thought I had this lighting perfect and
yeah.
then not perfect. So
It
I
was
was
bright
thinking
earlier.
about
Now
that.
it's much more normal. Yeah. It looks great.
But anyway, the when I'm done with this, here's the other things I've got to do today. I've got a practice tonight with our church choir, and we're going to have a song that we're singing on Sunday that I have not looked at yet because of my leg
Right.
issues. I haven't been able to go to any practices. I
Gotcha.
finally got my leg to the point where I can actually walk down the stairs in the practice hall and I can actually drive now, so that's worked. And I'm a bass, so I need, and they could use me. I'm going to add some value to the choir, so I'm going to be practicing. I'm going to listen to those tracks and the bass part and actually practice singing for a little bit here. And then I've got some flags to pull in the backyard. So I'm going to get my son and I was trying to design certain things that were going to be replaced. And because of the schedule, the trip to Portugal I just went on and just a lot of variables, I'm not going to be able to do this until February 15th. So rather than look at flags everywhere, I'm going to pull those flags, put them in the storeroom, and the yard will look prettier. I've got to pick up a pair of long distance glasses that just came in to the optometrist. So I'll be running by there now that I can drive. And I'm going to drive down to the workout area in our subdivision, which has both cardio and weights and weight machines and all that. And because my right leg is not quite up to snuff yet from the injury that I suffered a couple of weeks ago, I'm going to stay away from anything that involves my leg and just do upper
Yeah.
body. So I'll do a whole bunch of weightlifting and kind of make up some exercises that I can do sitting down on the workbench and the weight bench. And I'll do that for about a half an hour. I'll have my afternoon run. 7 o'clock tonight, I'll be doing the choir practice.
Right.
Somewhere along in there, I'll grab a bite for lunch. Around about 1:30, 2 o'clock, I'll be doing the afternoon run or afternoon process. That's pretty much my day.
Great.
That'll pretty much between that and answering a few emails and checking to see if anybody called me on the phone because I had it turned off for the last 2 hours. Uh,
Right.
that'll pretty much consume the rest of my day. So I get a little bit of blend of workout. I get a blend of outside. I'll get out of the house completely and go run an errand to pick up my glasses and get those fitted to me.
Yeah, that's great.
That's a typical day in retirement for me.
No, it's yeah, I mean it sounds like a pretty full day. And I know that you I know you play golf as well, right?
Yeah, not with my leg
Not with
right
the
now,
leg
but yeah,
currently.
I'll be trying to start swinging around Thanksgiving again.
Okay, that's not so far off.
No, I'm
And
doing well. I'm getting around pretty well now.
do
Given
you
that it's only 2 weeks after pulling the tendon in my knee.
yeah, I know. I think it's remarkable. So I'm seeing you back, back on the green pretty soon here. Do you see many parallels with golf and trading?
I do. You can never do both perfectly. You
Yes.
can only try to strive to get better at it. That's one thing that comes to mind immediately. Another thing that comes to mind is making a mistake or losing money, or having a bad shot or losing money. It's not making a mistake. It could be making a mistake, in which case you're saying to yourself, okay, I can tighten up the mental side of what I'm doing so I don't make those mistakes. Mistakes would be something where you didn't go through the process, select the right club or consider the wind or consider the slope of the lie. In the case of trading, of course, it would be not following your strategy, for instance.
Yeah.
Uh, so mistakes can be made, and as human beings, we do make mistakes, but using automation and getting experience doing what you're supposed to do, you kind of get better at not making those mistakes. And then it's just a matter of similar to trading, you take a loss, but it's part of your strategy. You hit a bad shot, but you're going to do that in golf every now and again. It's how you can escape from that bad shot and where did you miss? Did you miss on the correct side of the green where you have an easy up and down, or did you put yourself in the water on the other side of the green in which case you just ran your score up by 2 shots.
Right.
So there's a lot of similarities between the two. Staying with the process and letting the results take care of themselves. Trade and execute flawlessly. In the case of golf, it's same process every time, analyze. It's a different shot every time, but it's a similar process, and executing that process and not even worrying about what the score is until you get in with the guys, at the clubhouse, and you're telling stories about what happened during the round, or what's happening in life. That's the time to add up your score.
Yeah.
In the meanwhile, just concentrate on what you got to do for the next shot. Execute.
It's
And
it's it's
the
very
more you
similar.
execute flawlessly, probably the better your score is going to be.
Yeah, I mean, there's so many parallels, and I'm not a big golfer, but I'm very familiar with, with the parallels, and I can see exactly what you mentioned there. You talked
Yeah.
about mistakes, and Van would often say that mistakes cost you. What did he say now? I think it was on average something like 4R, like or two. It was 2 or 4R, and I can never remember, but it costs you more than you think when you
Yeah.
make one of those errors. So if you can do whatever you can to reduce those execution errors, um, and of course, the other side of it is keeping your mental game straight if you do make an error, right? Because if you
Right.
go and if you make a mistake, lose that 4R, beat yourself up, and then,
Or you try the
fumble,
try the
fumble,
miracle shot. You
right?
screwed up your second shot or first shot on a par 5, and then you say, well, I'm going to go for the green and I'm going to try to see if I can uh,
Yeah.
go for the green on this thing. Your second shot screwed up, and you got a long way to go, but you're going to try it. Yeah, the famous last words. And then, now you're in deep crap, and, and now you're scrambling, and you're testing your short game and your putting and everything else.
Yeah. Well, that's fantastic. Thank you for running through all of this. I feel like we should probably wrap it up and that I should let you
Right.
go. And I'm just being greedy now. Um, but thank you so much for all of your insights. Is there anything that I didn't mention today that you'd like to talk about, or anything on your mind currently?
No, just I think you mentioned the website. I think that's the easiest way. A lot of people can get into my head. This interview will eventually be up there. The last one is there if you want to
Great.
watch that and circle back to it as a precursor to this one. But I'll put this one up eventually when you get it packaged. And I must have close to 80 or 100 hours worth of me
Wow.
being interviewed on there. You can watch all of those for free. You can read all my research papers. You can get a lot of discussion of hedging on my hedging page. You can see the books that I recommend in the order that I recommend them. There's just a lot of stuff in there. There's a frequently asked questions that you can download for free from the store that covers a lot of the questions that a lot of new traders would tend to ask me, and that I used to, try to try to answer dutifully, thousands of emails over the years. Now I just refer them to the frequently asked questions, and it saves me a heck of a lot of time. And
Yeah.
uh, so there's a lot of resources there that, and then there's stuff you can buy too if you want to help support the website with buying a book or a recording or whatever. But the website's existing just fine without it. You don't need to buy anything if you don't have to. It's up to you. And I think that that's probably the best way to find out more about me. And you can follow me on Twitter with the 55.5 thousand other people, mostly traders,
Wow.
that have followed me now over the years. And every now and again, something comes to mind and I put it up there. I don't bother people with a lot of posts, but I try to, when something catches my eye or hits my brain the right way, I might put something up there, and I have a pretty strong following. So,
Yeah. No, I'm one of them. I liked your photos from business class, running your process that you put up, I forget, last week or so.
oh,
That was pretty
on
good.
Air Canada.
That's it. Yeah. Yeah.
Yeah, on Air Canada, they were
Had your
nice
two
to me.
screens going, and
Yeah,
you
I got
got
my portable travel screen to my left, And my wife was on the other side. Actually, she was taking the picture, so she wasn't sitting there, but she was in the left-hand
Right.
seat of the middle section, and I was on the right. And I had my monitor to my left and my laptop on the tray table that comes out, and yeah, I got everything done at 38,000 feet.
Wow, that's great. It looked very comfortable and like spacious, you know. So yeah, well done. Nice to know that you can get it done, while you're on the move like that. Um,
Yeah, it worked out the time wise. I knew I was going to land in Montreal, and I knew that I knew the time period in Montreal was not going to be too good to get the connection. So I said, the only way to do this is over the Atlantic on the way from Lisbon. So I said, okay, that's what we're going to do. And I geared everything up for that, and even called ahead to make sure that they had Starlink or an equivalent, and they did. And so it's like $15 or something. And
yeah,
and I think it was Canadian even. So that's only
bit less.
US, it's
Yeah,
only like 10 or $11. And yeah, fired it up and it worked beautifully. I got all my work done. I even cranked out some emails and
great.
did some social media posts, and we took a few photographs. I took one with the crew that up in business class
I
that was
saw
flying
I saw that.
Serenity,
Yeah, yeah, that was
and
nice.
give them some notoriety. And yeah, it was fun.
Yeah, well, that's
That
great.
was a first. I'd never done my process. I try not to travel any more than I have to. I mean, this office that I'm sitting in was designed from scratch by me to be sound efficient, light efficient. I've got a big screen TV if I want to watch the financial markets, which I usually have off. And I got great sound systems so I can play my instrumental chill jazz. I don't know, perfect sound, perfect lighting,
Yeah.
a great desk, two big screens. Why would I want to go anywhere? This
What,
is
what more do
so
you need?
easy. But
But you need
my lovely bride loves to travel. She was a realtor all her life, and I grudgingly go along and help carry the luggage. And
to. Well, you're
it's
you're enjoying the ride, is what you're
I
doing.
try to. Some of those rides are a little bit harder than others. When I can't get business class and I get stuck in a coach seat and I'm 6'3", that gets a little tough on my knees. But I try to deal with it. I try to still take my hour every day to get my work done, even on a vacation. I try to have provisions to have Wi-Fi and take a break from the vacation to, do my normal stuff and then go right back to vacationing. And we're gonna do a cruise coming up that's going to be interesting and set some new records for me. We're leaving on January 1st from the Phoenix, and we're going to go to the Seychelles off the east coast of
Wow,
Africa. And
that's a
then we're
that's a
going to get
trip.
on a cruise ship and we're going to visit the Maldives. Let's see if I get them correct. Sri Lanka, Indonesia, Kuala Lumpur, and Singapore. And
Brilliant.
we get home on the 21st. So it's going to be like a 21 to 22 days
Wow,
of,
that's great.
um, of a massive cruise. They do have Starlink. I've already checked
I knew you would. Yeah.
ship. So I'll be doing my process and taking time to do that. Although everything is flip-flop, where I'm doing it at 2 o'clock in the afternoon, I instead would be 2 o'clock in the morning because it's around 12 hours difference.
Of
So
course.
I'll really be doing my process more like 6 in the morning, probably.
Is there a bit of wiggle room on when you do the process?
Yes, there is,
Yeah.
because markets close for a while.
Yeah.
And some markets don't trade enough to make it worth your while. So there's usually a period in this time zone. It would be from about 1:30 all the way to about 4 or 5 o'clock.
Okay.
And it really only takes me about 40 minutes. So usually I try to target it around 2 to 2:30. And I usually wrap it up around 3 to 3:30, somewhere in there. That's kind of the sweet spot. So I try not to do too many appointments, like to get a haircut or,
Right.
go to the optometrist for my eyes. I try to do that sort of late morning, like I'll have an interview with you, we'll be done. I can make a run down, pick up my glasses, get out of the house, be back for lunch, that type of thing.
Yeah.
The day will play itself out as it plays itself out, but I'll see where we are. I didn't know how long this was going to take, so I just left everything open and I have nothing scheduled. But if I have time, I'll
Thank
just
you.
run down, pick up my glasses, and on the way back, I'll either stop and eat something along the way, or more likely, I'll come back here and grab something out of the refrigerator. And pretty much I'll be close. I'll be at that point wiping out critical calls that I need to make or emails that came in. And
Yeah.
then I'll be into the afternoon process. And then
Right.
somewhere along there, I'm going to listen to the song that I got to sing tonight. Uh,
Are you ever tempted to automate the process more? I know that you're sort of doing that manual sanity check on the final order transmission, like into Interactive Brokers. It clearly could be done, I guess, like technically.
and
Um,
Trendstat used to do it.
oh, okay. So you did it way back then. And so
Yeah.
is that something that you're like would like to get back in place to allow you
Yeah,
to
I
not wake up
would
at 2 in the morning?
personally, but I tell you what, I'd rather have the platform out for people and being used and add that as a feature in 2.0.
Yeah.
Uh, that's something that long term I think would be a useful thing for multiple systems traders, but most people are not going to be multiple systems traders out of the gate. And I would rather have a useful platform that people are using,
Yeah.
and the platform's actually bringing in revenues and hiring people, and we're able to expand it, than to try to make it the end all be all,
Yeah.
have every bell and whistle in it that I could dream up. That would be something that would be down the list of the priorities because it's so simple for me to spend 10 minutes in the morning. And I'd probably at least be looking at the overnights anyway, just to see kind of what happened. And it gives me a feel for what is happening in the world, economically speaking, which affects me as a human being, not as a trader, but as a citizen of the world. If war is breaking out in the Middle East, I'd kind of like to know about it, just
Yeah.
as a human being. Um, so I think I would be checking certain things anyway. So it's just not that much of a burden, and certainly not something I want to dedicate, weeks or months of some programming time to trying to make that all automated when it really is not that big of a deal.
Yeah. Yeah.
So we're
Fair enough.
trying to, we pretty much have everything we think we need to make the product a superior product to most of everything I've seen out there. And it'll operate in the cloud, which is wonderful. That means I could actually start my process from a cell phone on the cruise ship and not have to mess with doing a lot of stuff that I do now.
Great.
But I think that we're almost there, and we just got to try to get to beta testing next. And we'd like to get the product out there into the world in 2025. At the latest, January 1st, 2026 is the deadline. And we're working towards that as fast as we can.
Great. Well, I mean that all sounds fantastic, right? So um, we're getting a couple of nice comments coming through on questions, saying that that they've enjoyed the session, and so thank you again for all of your time. The platform sounds great. I'm sure we'll hear more about it as
Oh,
we
yeah.
it's kind of
When it's ready, you'll hear a lot.
trader. Yeah. In the
There'll be me
meantime,
doing videos and webinars
I
on it,
bet. I bet.
probably.
Well, I'll be super keen to hear about it.
Yeah.
In the meantime, I know that with All Weather Trader, what you're trying to do is impart your wisdom and your trading experience, but also it's that balance of not spoon feeding absolutely everything to somebody because not every system is going to work for everyone's different, as you said, multiple times,
Yeah.
right? They
What
need
I
a
would,
different system. So
Yeah, I was basically kind of using my own life and education and experience evolving from not knowing what the heck I was doing to where I am today, which I'd have to say I think is pretty good place for a trader.
yeah,
And I just tried to take the traders through that to try to get them to understand the mentality of, okay, here's where I was up to that point, but I thought, well, how about if I add this instead? and that little feature became this. And now when we add these things together, we we're getting better and better numbers, and we're getting closer to what we would really like to have happen. And the specific examples in the book, I've had people go through the book and they send me emails and saying, in chapter 7, in your Bollinger Band, you used a 9-day and whatever, and they're asking me very specific questions. And I know they're trying to program that into their computer and match
Yeah.
it completely. None of that is magical.
Yeah.
If you're a guy that wants the action, you should throw out what I do with my long-term trend following. That would be boring. You would just ignore it. You'd screw it up because you'd be bored. You have to understand yourself, understand the problem to solve, and then use those as just sort of examples of some ideas that I threw together to satisfy my own financial challenges and as examples of some things you can do, but there's a million other things you could do. I'm just throwing out some examples to stimulate the brain and
Sure.
allow people to understand how I solved my own problem, and hopefully that motivates them to solve theirs.
Yeah, and I totally understood that from the book. I have it here, that's why I keep looking over. I recommend everybody checks it out. Because it's you've kept it simple, but you've also kept the ideas a little bit broad so that they can be seasoned to taste. And one of the things that we're trying to do with this workshop that we're going to be running is taking some of these ideas and showing people how they can implement them, so that and the coding of it doesn't necessarily need to be super complicated these days. Most things can be done with a small amount of code, and that way there you get to take maybe an idea from you, have a look at what it looks like on an actual platform. What do the results look like? What do the trades look like? How would that feel as I'm actually running that, if I go day by day, bar by bar?
Well,
Um,
how about if I offer this? How about if you can work it out with my schedule and the time zone switches between London and here?
yeah.
Uh, I am not familiar at all with TradingView. I've never used it.
Okay.
I have seen it a few times, but I would be intrigued to learn what you're doing with TradingView and how to do that. And I would be
Great.
happy to be on the seminar or webinar or whatever. And
Awesome. I would love that.
and then I could throw in some suggestions along the way if I spot stuff that you're doing.
Yeah.
Uh, that'd be fun for me, and I'd learn more about TradingView.
That'd be fantastic. So I'll take you up on that. I'll send you the
Okay.
details and everything. It should be doable in your time frame, I think. Um, well, it's going to be on a Saturday because most people can make it on a Saturday. So if that's possible for you, then
Yeah, just if it's Saturday in the morning in the UK, I'll be sleeping.
yeah, no, it's not in the morning. I end up doing the late shift because a lot of the people that we work with tend to be in the US anyway.
Okay.
So yeah. So yeah, we're getting a few comments through saying that would be awesome if they would come along and that your insights
It'd
into
be fun. I love doing stuff live. It's not an issue for me. I've
I
been
think you
doing
you
this
pick it up
50
pretty
years.
quickly. Yeah.
It's not
Yeah.
it's not like I don't know the topic or anything. I don't have to study.
Yeah. Yeah, exactly. No, you just get to come along. Yeah. Well, that's great, and what a great way to wrap it up. I'll get you all the details over to you, and
Okay.
again, thank you so much for just chat. I mean, I really enjoy going through the system with you. I mean, that's just it reinforces many of the things that I've kind of picked up and done over the years, and and it's just great to see, and you did it so succinctly, right? So I'm going to carve out that little piece there. Maybe I'll put that into a little system as well, just to see as an example what that sort of thing can look like and how it doesn't need to take months to be able to go from an idea through until getting it into an actual process and live into a trading environment once you understand what you're doing. So anyway, we could go on for hours more, I'm sure.
We
But Tom,
could.
thanks so much. Enjoy the rest of your day. I know
I will.
you've told us the plan. Um, we've got a few people saying that they're in, that are watching here still. So that's great. To everybody that's been stuck with us this whole time, thank you for sticking around. It's been an epic one. I've really enjoyed it, and I'm sure we'll talk again, Tom. I always look forward to it, and if not, I'm sure I'll see you on Twitter soon. So Thanks again, guys. Tom, have a great rest of the day, and we'll see you guys again in the next one, hopefully. Look out for the podcast and all the likes and subscribe things that I don't know how to do yet, but we'll work it all out. All right.
All right,
Great.
Jeff. Have a good
Thank you,
one.
guys. Enjoy.
Bye-bye.
Cheers.